In the last 15 years, there's been a number of corrections on the S&P 500. And in every single one of them, when the S&P goes down more than 10%, the dollar index, the trade-weighted dollar index goes up. This time, the dollar went down when the S&P 500 went down almost 20%. That's strange. Things are behaving differently. Usually when the Fed starts cutting interest rates, rates across the yield curve go down. The 10-year Treasury almost always goes up immediately following the first Fed rate cut, and then it keeps rallying for a while. This time, the 10-year yield went up, and the yield curve is steepening. So I think what we have is a recognition that the interest expense for the United States is untenable if we continue running a $2.1 trillion budget deficit and we continue to have sticky interest rates. One thing that people fail to appreciate is how much the average Treasury payment has gone up. The average yield, the average coupon on Treasuries was below 2%. The entire Treasury market, all 30-odd billion of it, you average it all together. Some of them are old, they were issued with higher interest rates, but it was below 2%. Now it's pushing 4%. And as long as bonds are maturing, and there's trillions and trillions of dollars of them maturing, a lot of them were issued back in, 2009, 2008, these other time periods. Even if you just issued them in 2019, some of these are starting to come due. And they were issued with coupons of 0.25%. And now it's 4.25%, so it's 400 basis points higher. So this problem continues to build, and there's an awareness now that the long-term Treasury bond is not a legitimate flight to quality asset. It's not responding to lower interest rates. It's not really responding to an inflation rate, which is now 2.5%. Probably going to go higher on the inflation rate because the ones that are rolling off from a year ago, the cumulative, I think, headline CPI that came out today, it was a 0.18, but the one that was rolling off, I think, was 0.1. And if you do the next 2 months, those 3 months together, that quarter, the cumulative rise from a year ago was 0.1. So we're likely seeing the low point in near-term inflation. So yeah, I think the reckoning is coming, is that we have to somehow figure out how we're going to deal with $37 trillion. We're actually going to hit the 37 trillion number for real. It's still 36.95 trillion, but it's going up quickly. So yeah, there's going to have to be some pretty creative thinking, and the market's starting to believe that.